By far, one of the most common questions I get from people is, as business owners, what expenses can I deduct? So this video is really focused on business owners, okay? I mean, the name of the channel is We Love Small Business, right? But there are some very specific differences in what individuals who do not own businesses versus the ones that do. There's lots more a business can deduct than what individuals who don't own a business can. So just keep that in mind. Now, before I start, I do have 3 general rules I want you to remember when it comes to expenditures, and I'm going to refer to these throughout the video. The first, do not make tax-driven decisions when deciding on expenditures. Don't even think about tax treatment when you're deciding on whether you should make an expenditure or not. The decision to spend money should be based on good, sound business decisions. Things that'll help you continue the business or improve the business, make the business more productive, or help save some money. A lot of people will let the tail wag the dog, and they'll actually spend money with the sole purpose of reducing tax. No, no, and no. Be rational here. You are in this to make money. Make decisions based on whether expenditures are going to make you money, not save you tax. I've seen a lot of people let their emotional hate of taxes make them do some really stupid things here. Okay, I know taxes suck, but they're just a thing we need to live with. So let's really show the CRA who's boss and make so much money in our businesses that we laugh at their silly taxes even though we have to pay them. Just let the accountants deal with the tax side of things, and you go make money. My second general rule, have a solid bookkeeper, seasoned, has been around the block. They're not the cheapest. They love working with CPAs, not replacing them. They're consistent and detail-oriented. They're prompt. They make your life easier, not harder. Take great care in finding this professional. They make all the difference. And if you're having a hard time, your CPA should be able to help guide you to the right fit, which leads to my third and final basic rule when it comes to expenditures. The third basic rule is this: have a good, solid CPA in your life that makes a living offering public accounting services. Like it's their full-time gig. A CPA firm, not a bookkeeper that can whip up a quick tax return for you, or a family member that might be a CPA but doesn't work full-time in a CPA firm. I have nothing against these folks. It's just that the rules around expenditures can be subtle and sneaky and particular and individual, and really needs the love and care that only a seasoned CPA can offer. And CPAs are required to be up on this stuff all the time. We're required to get minimum training hours every year. This is not the place where you want to save money by finding less experienced, non-qualified people. Like you've heard me say before, keep your friends close, but your accountant closer. Okay, let's start off with the general guidance that the CRA gives, and then I'll attempt to help with some specific expenditures that have some weirdness attached. So here's the general guidance that the CRA provides. A business expense is a cost you incur for the sole purpose of earning business income. So I want you to prime your mind to think about each and every expense you pay on behalf of your business. Like actually have a recurring question going through your mind each time you get out that Interact card or the checkbook, like an algorithm. How could this expenditure relate to my business? And then, keeping in line with this algorithm, I want you to imagine a CRA auditor right across from you and how straight a face you can keep with them as you try to explain why you think it should be a tax-deductible expense. It has to be reasonable, like expenses that people in your line of work need to incur to run a proper business and earn income. Okay? This will get you most of the way there, believe it or not. And as long as you or your bookkeeper's doing a good job categorizing your expenses, we, the year-end accountants, can make sure we are dealing with the weirdness of certain expenses on your behalf. But to repeat, if you keep this algorithm in your head, make sure you're doing a good job categorizing. You're going to be mostly there. Now, the following, and I'm only going to hit the biggies here, not the obscure stuff, because for 99% of you, this list will be the only things you'll ever deal with. Okay, here they are. Capital expenditures. Capital expenditures are typically costs incurred for like acquiring or improving assets that have long-term benefits. And they're not fully deductible in the year of purchase. Instead, they're usually depreciated over several years through a process known as the capital cost allowance. So think of office equipment, machinery, buildings, that kind of thing. There's also some very specific rules within the capital cost rules, which are way beyond the scope of this video, but rest assured, your CPAs on this stuff like stink on a monkey. Just make sure you clearly categorize expenditures that have a longer useful life. Repairs and maintenance. Well, for the most part, keeping your capital assets in good repair, like your vehicle or your office building repairs, are fully tax deductible. But sometimes folks aren't sure if the expenditure that they're paying for, because it might be a very big expenditure, is capital, which needs to be written off over time, versus an expense, which is deductible in the year it's incurred. And again, good details are important here. A good CPA will go through your repairs and maintenance category and help make a decision on the tax treatment. You don't have to overthink here. Vehicle. This is a loaded subject, which I've done specific videos on, and I'll put links to these in the show notes. But here's the big thing on that. You need to keep a logbook tracking your business and personal mileage. I'm sorry, you just do. That's the big thing the CRA will ask for in an audit. Now, if your incorporated company owns the vehicle, you can go ahead and claim all the expenses related to the vehicle, like gas, oil changes, tires, yada, yada. But there's possibly a personal benefit that you'll need to report on your personal tax return. And again, your CPA will ensure this is all taken care of properly. But they're gonna need that logbook to calculate it. So sorry, you need a logbook or a mileage tracking app. Now, if you personally own the vehicle and you occasionally drive it for business purposes, then rather than the company paying all the operating expenses on the vehicle, you will pay those expenses personally and have your company reimburse you for each business mile or kilometer travel. The rates usually change every year, sometimes every couple of years, but they're quite beefy rates. And the good news is that the mileage reimbursement is tax deductible to your company and not a taxable benefit to you. And the company can even back out the GST or the HST of the reimbursement and get it rebated. But you need to track. Your CPA can help you decide which way you should own a vehicle. Now, I get this one a lot, which is vehicle lease payments. And the answer is, well, yes, they're deductible, but there's limits. And if you buy a vehicle and it's set up as a capital asset that you can write off over time, there's limits there too. So like I said, the vehicle is one hell of a loaded subject, so just remember my general rule. Do what makes sense for the business economically or psychologically, but get this tax-driven motivation out of your head. It ain't worth your brain power. It's worth my brain power, and I will make sure we're dealing with stuff properly, but just focus on making good decisions in your business. Oh, and one last thing on vehicle expenses. The mileage you incur to drive from home to work is not considered business travel. This is a personal travel. It just is. Charity. Well, for the most part, if you're incorporated, contributions to a charity are fully deductible against income, but there are restrictions. For example, it maxes out at 75% of the company's net income, but then you can carry the deduction forward in other years. So for the most part, not much to think about here. Just categorize it properly. Now, if you're not incorporated, make damn sure you get that charity receipt and make sure the charity's business number is on the receipt. And your accountant will know what to do with this on your personal tax return. Now, if this is a big line item on your income statement, talk to your accountant specifically on this because there are some funny rules around these. Business use of home, and I also did a video on this and I'll put it in the show notes. But the big thing here is keeping all those occupancy expense backup. You know, your property taxes, your mortgage, year-end mortgage statement, the interest, the power bills, you know, that kind of stuff. And give that summary to your accountant at the end of the year, as well as the measurements of your office compared to the total livable space in your house. Now, the only other thing I'll say here is you can't really claim a portion of your house if you already have an office in another building. You can't double up, all right? Travel. Okay, again, first think of the general rule and run it through the algorithm that we talked about, and then be reasonable. If your business earns money as a direct result of your travel, you're good to go, but be reasonable. For example, if there's like a 2-day conference or trade show you attend in Las Vegas, but your return airfare and hotel accommodations are for a 4-day stay, the CRA aren't stupid. They know that there's some personal time here that you're blowing all your kids' inheritance, or you're going to see those blue men show. But anyway, in this case, you'll prorate the expenses for 50% business and 50% personal, right? 4 days total, for which 2 days were for a trade show and the other 2 days were for the blackjack table. Clearly personal time. Meals and entertainment. Now this one is a little weird. First, to deduct a meal, it must follow my algorithm, right? It has to be reasonable. It needs to be business related. And if you're audited, the CRA is going to want to see records supporting this, and things like the purpose of the expenses and the names of the attendees should be noted right on the receipt. So like, you know, if you're trying to deduct Happy Meals from McDonald's and you don't run a daycare, you might have a hard time justifying those meals. Now, the other thing about meals is that they're limited to 50% of the cost. Your accountant will take care of that at year-end time, but just be aware that this is not a fully deductible expense. So what about golf membership fees? Nope. Flat out, nope. I know you do a lot of business on the golf course, I know, but no, the CRA's got a real hate on for golfers. But to be fair, you really can't claim any membership fees related to leisure type stuff. Now what about business suits or my salon fees or my massages? Like, these are personal expenses. I mean, I know they all cost a pretty penny and arguments can be made for how they help us make money, but no way, no how. These will be considered personal expenses by the CRA, so don't even bother trying and sleep better at night. So what about professional fees? Okay, well, it depends. For example, professional fees like lawyers and accountants fees for getting your business incorporated, they're tax deductible, but there's limits after which the remaining amount needs to be set up as a capital asset and written off over time. Now, I don't want to get into the specific limits because these limits change over time and I want the videos to stay relevant, but your accountant can make sure that you're aware of the specifics at incorporation time. But what about professional fees relating to the purchase of a property like a machine or some land and building? Now, these are typically capitalized and written off alongside the asset that they relate to, except for land. Land actually doesn't depreciate. So if there are professional fees directly related to the purchase of the land, those fees will get added to the cost of the land and used to reduce any capital gains incurred on the sale of that land down the road. But what about professional fees for reorganizations? Like, for example, getting a family trust or holding company set up. Again, there are limitations which your accountant can advise you on, but just don't assume that these are fully deductible. And look, if you're getting a divorce, those are not deductible in any way against business income, and don't even try it. Oh, and by the way, in my experience, professional fees are an area that the CRA do like to look at, so be prepared that you might have to forward the invoices to them for their review. What about loan payments? Okay, so like mortgage or term interest related to an asset purchase in the business or even working capital loans. Yes, the interest is deductible, but the principal repayment is not deductible, which makes sense, right? Like, you didn't have to report the proceeds on the loan when it was issued to you as income, so why would you get a deduction when you pay it back? So what about lump sum finance fees, like the CMHC charges and stuff like that? Well, they get written off over time, and your accountant will know what to do with them when they do the year end, but make sure you have descriptions in your books so that they don't miss these. What about sweat equity? And I get this a lot. People say, can't I get a write-off for all the work I'm doing for the business even though I'm not drawing any salary or getting paid? Well, first off, they call it sweat equity because you're increasing the equity or value of your business by doing some of the stuff on your own. And if you're not paying yourself, then you're saving the fees that you would otherwise have to pay to someone, including yourself. Now, if you decide to pay yourself for the work done, the business might get the tax deduction, but then you just need to report it on your personal tax return. So get deductions for sweat equity out of your head. What about insurance premiums? A loaded question. So business insurance, like liability or vehicle insurances related to the company vehicle, yes. But what about like health insurance premiums paid on behalf of your employees? Well, yes, provided this benefit is provided to everyone, not just you, the owner, right? There's lots of kinds of insurance and lots of ways they can be deducted. So this is definitely a chat with your accountant. But also, don't forget my general rule here. If it makes sense for your business, spend it and let the tax deductibility chips fall where they may. So these are some and most of the regular expenses that we deal with, but there's little nuances on many expenses, like how bad debts are dealt with, or even research and development, just to name a few. Remember my 2 basic rules, and honestly, don't get too caught up with the tax side of the stuff. Just get out there and enjoy what you're doing, and don't be afraid to give your accountant a buzz here and there and tell them what you're up to. Okay, now go out, make money, and only spend money if it'll make you money. Till next time.